So, autumn budget last week, most probably one of a budget that introduced the most significant changes for business owners that we've had for a long, long time. A lot of them will affect your succession planning. So we're going to go through some of these changes and see how they work with the different options that we have available to you. I'm lucky enough to be joined today by Richard, who's going to be answering all of my questions. Richard, would you like to introduce yourself?
Yeah, so I'm Richard. Good morning, everybody. I'm Richard. I'm the tax director here at MPA, and for the significant latter part of my career, I've advised small and medium businesses on structural issues, meaning anything from startup to exit, and how to achieve the goals that you have from a tax perspective.
Thank you. I'm Samantha, Wildman, client director here at MPA. I spend most of my time speaking to clients, understanding their needs and challenges, and looking at how our services here at MPA, which can be anything from innovation funding, accounts, legal, HR, specialist tax advice, succession planning, or maybe other things within our network, can help our clients on their journey of growth. When we look at succession planning and the type of businesses that we're mainly focusing on, if I look at our client base, we're mainly looking at the business manager owners of the business. Mm-hmm. And I see that they fall into three categories. You have the serial entrepreneur. They most probably know their exit strategy on the day that they start. Mm-hmm. They've got a 3-5 year plan. They know who they want to sell to, and everything's geared and their journey's on that. You've then got the person who started a business. They've worked in that business for 20, 30 years. They've got to a stage where they've now been able to stop working in the business and maybe working a bit more on the business. Mm-hmm. They've built up a good senior leadership team, and they're there now thinking, what's next?
Yeah. And
then the third category is that family-owned business where maybe it's being passed down from generation to generation. You can have the conversation with either the generation that's currently running it and in charge of it, or we tend to quite often have the conversation with the generation that is the next one that's coming through. Mm-hmm. Maybe they've worked their way through to the business. They're now part of the senior leadership team. They know that the business is coming to them, but how do we make all of that happen?
Yeah.
So they're the three types. How do people know what they need to know to think about succession planning?
Well, it's never first thing to say is it's never too early to think about it. As you said, serial entrepreneurs pretty much know from day one, if not before, what their exit strategy is going to be. The key is to think about it. Is to kind of imagine, dream a little bit as to where it is that you want to go, what you envisage of what you know of your spheres of influence, I guess, at the moment, in terms of who could you possibly sell to? Are you not wanting to sell, but you're more interested in legacy, which is not necessarily financial? It's I've built this thing up, I want to build this thing up, and I want it to endure down another generation, either family or generation of leaders who've bought into the vision and run with me on the journey. So one key thing, which we'll come back to probably, is making sure that you are thinking about the who as much as the why and the how. It's who do I need to be getting on board with my thought process? That can change over time, but who are the people that I need to get buy-in from for what I envisage? Because very often we see the owners having thoughts about how they ideally want it to happen, and ultimately you're in control of that. But to actually get it across the line, you need other people. So it's getting around the table with them at an appropriate stage. But as I say, you can't do this early enough.
Yes, exactly. And again, I'm having problems with my slide moving forward. But I have a glamour assistant on the other side who can move it for me. But the next slide leads really much into what you were just saying there about the why and the who. And I know this is where a lot of people struggle. And I know when we're talking to people on a daily basis, succession planning comes up as a really important topic, but lots of people just don't know where to start and how to start.
Yeah.
And I think you mentioned the who. That can be quite emotive sometimes as well, can't it?
It can. It can. I mean, you take the example you alluded to of the family business. You know, if you're the founder, you started it, then chances are your children have been on a journey with you. If you're not the founder, you've inherited from that generation that inherited first time. Then what we see sometimes, not always, is that passion that you may have gets diluted down the generation. So it can get emotive because there might be one part of your family, your children who are in the business, are passionate about it, and the rest aren't. But you want to somehow be fair to all of them, and those discussions get potentially harder as you go on. Also, you've built something up. If it's not family business, you've built something up, and letting go sometimes can be really, really hard. And therefore you get more protective and more, that I need to be really sure. But then I need to be really, really sure of what I'm doing. Particularly if you're into protecting the legacy of the business, as opposed to I want to maximize the value out of the business and I don't care how I do it.
I think your why question now becomes more important than ever. I was on a conversation with a client yesterday and I said sometimes you may find speaking to us is a little bit like speaking to some kids from a nursery, because I'm going to keep asking you why. Mm-hmm. Why are you doing that? Why did you do it that way? Why? If we now look at the changes that the budget brought in, I think your why question becomes even more significant, because as I mentioned earlier, these changes are really going to affect the bottom line. Mm-hmm. So you may have gone down one route because it was the better option, maybe financially, but now you've got to understand what your real why is to then find your better option, because the financial side of it maybe not the same as it was before.
Yeah.
Hopefully my slide will move forward and we can quickly go through some of those changes. Yeah. And I know you did the budget overview last week and some people have seen it, but if we can just do a high level understanding now, and then the next slide is going to take us through how they affect each different option.
Fabulous. Right. Okay. So the changes in the budget last week, some of which are just confirmation of what was announced the year before. So for business asset disposal relief, which used to be entrepreneurs relief, which a lot of people still refer to it as, the tax rate is now from April next year is going to be 18% on the first £1 million of taxable gains. It's currently 14%. Historically, it was 10%. And this just shows how, as part of this whole conversation, how things change. And if you're looking 5-10 years out, just having a mind to the fact that what we know today might not be what we have in 5-10 years' time. So, for example, with business asset disposal relief or entrepreneurs relief, only 6 years ago, a little over 5 years ago, it was £10 million at 10%. That's a different conversation to £1 million at 18%, especially when the headline rate of capital gains tax is 24%. So the differential is now 6% between what you would normally pay and if you qualify for business asset disposal relief. So, I mean, if anybody's in the throes of selling between now and April, it's a £40,000 saving you make, which on the face of it's not massive, depending on what you're selling for, but it's still £40,000.
Yeah, I'll have it, please.
You'll have it. Yeah, well, I'll split it with you. It's great. So there's that. The second thing is inheritance tax, and this is particularly when we come to family companies, but not only family companies, is hugely significant. So it was announced last year. There's been a huge amount of stuff around it, particularly farmers invading Whitehall with tractors. But it affects every business, every single business, not just farmers. So what used to be the situation is you pass on your shares in your family company to the next generation. You get 100% business property relief or agricultural property relief. And that was to stop businesses having to be broken up and finding cash from somewhere to pay tax on the way through. So from April next year, transfers of shares will now be subject to £1 million cap on the 100% relief for inheritance tax, and anything over and above that is going to be 50% you'll get relief on, and the rest is taxed in the normal way, depending on what the rest of your estate looks like. So that's a significant change, a massive impact, and puts an onus on people knowing the valuation of their businesses, which is another aspect we'll probably come on to. One option that we hear talk about a lot, because we ourselves are one, is employee ownership trusts, so EOTs, and up to budget day, all gains that you make when you transfer shares into an employee ownership trust, have been exempt. There's been no tax on the value that you transfer. Now you're going to pay tax on 50% of that. Okay, that makes it an incredibly less attractive option as a route to disposal. And there are significant changes to share incentives as well. They're the main things that have come out of the budget, some of which have been confirmed.
Yes, and if we go on to the next slide, we'll look at the different options, or the main different options really, for succession planning. And if you can then slot in where the changes are going to affect, that would be great. And maybe give a brief overview of what they actually are. So I'm going to start with trade sales.
So trade sales, so I think we've, as it says on there, 94% of sales in the UK are through trade sales, and that's traditionally the route that people have looked to. I'm going to sell either to a supplier, a customer, or somebody who's a competitor in my business. And that's one thing to have a mind to, is like, who are your potential buyers? So typically you are going to get the best value from doing a trade sale, but it comes with lots of nuance, which we'll come on to. As I've already said, the capital gains tax changes and the business asset disposal relief, entrepreneurs relief changes, have a significant impact on what you're going to get out of that. So, what was 10% now is 18% going forward in terms of a tax rate on the first million. Then, if you're selling for £1 million, then in terms of the percentage, that's a significant change. And you need to bear that in mind, because ultimately one of the drivers for you, not all the whole driver, but one of the drivers is your net cash you're getting out of this. And if you think, well, I need a certain amount to be willing to do this, then that's where the change comes. Okay. Family succession, that's where the IHT changes are very significant. And it's being mindful as to how much to give away and when, or you either give things away in your lifetime. There's a 7-year rule which basically says that if you give things away more than 7 years before you die, then they fall outside of any tax calculation. Okay, but then you think, well, actually, that would get round the business property relief changes. But how much do you want to do that? This is where the weaknesses come. Is if you give something away and you seriously have to give it away, it's not, oh, I'll give you shares, but if it's going to be dividends, then I'll have those. It's got to be a true gift. Then how does that affect the way you do business? How does that impact you achieving the value you want to achieve anyway? So all of these things need to be taken into consideration. And who are you gifting to? Yeah. And again, families are families, just like business is a business. Is what you know today might not be what you know tomorrow, or in 5-10 years' time. Employee ownership trusts, something which we always say we're very keen on here, but the impact on doing an EOT for the change in the capital gains tax rate is that where in the past an EOT you could sell to and you would get deferred terms, so your business is worth, say, 5 million, you might get paid 1 million up front, say, and you've 4 million you're happy to receive over a period of say 5 or more years, which will then be paid out of the profits of the business as you go along. All of a sudden you now need to have what typically would be 12% of the value, is how the maths works, available up front to pay the tax bill. Okay, that's not the whole picture. That tax bill that you might be facing can be deferred, but you need to get into a discussion with HMRC. It's not automatic, and in that discussion, they would say to you, right, every time you receive a payment against the deferred consideration, you have to give us half of it until the tax bill's paid. All of this changes the dynamic from what was a situation where there was no tax into one where it's a major consideration how you're going to fund that. And for some, possibly quite a lot, that will make it not an attractive option.
So the next slide is going to go through the pros and cons when it comes up, and I've got loads and loads of questions, but I think one of the things that's quite interesting is that we were at the Employment Ownership Association conference when the budget was announced, so on that day. They weren't overly concerned. They thought that most people who are going down employee ownership understand their why, and their why has always been around that legacy, or the fact that they can't actually find anybody else to buy it. So the icing on this cake has always been the extra tax break, and that's the balancing up for the fact that you've got to wait a longer time for it. But I suppose the negative is going to be if you're not a cash-rich business. If you're a cash-rich I can't say it, put my teeth back in. A cash-rich business, EOT is still a fantastic way of getting that cash out, and from a tax perspective, it's still cheaper than the other options. Absolutely,
it's still cheaper, and definitely something that needs to be in the conversation and in your thought process, even if it's something that ultimately we go, actually, that's not going to work. As far as the EOA, without being cynical, that's their business. That's what they survive on and exist because of.
Yes.
But they're not wrong. They're not wrong. It's a valid point of view. So all of which drives the conversation, which we could have, is down the route of what is value to you? What does value mean? Is value purely defined by the pounds you get out at the end of the day, or is a massive part of the value your legacy, and passing things on? One thing we always say with EOTs is, and we'll come on to contrast with a trade sale, but is that it secures the future of your employees as much as your business, the way you've done business, your culture. So if you're a local employer, then walking down the high street, you bump into somebody who worked for you and still works for your business. You know you can have a smile or go, how's it going? safe in the knowledge that they're still doing what they always did after you've sold.
Right, and that leads on really nicely to trade sale. So I think there are a couple of cons on there we need to pick up on legacy. You also said valuation was high in a trade sale, but there can be some negatives from a valuation point of view as well.
All right, so the trade sale route is, and we've got a few businesses going through this at the moment, it can be a tortuous process. Okay, so you will inevitably have your buyer wanting to run the rule over your books, your records, your history, if they're buying the company, because they're buying all of that potential liability. You know, if something comes out of the woodwork, they're going to want to know what their potential exposure is. Okay, so they may come along and say, "We'll give you £5 million for your business." Then during the process, they go, "Well, actually, that's not quite what we thought, and therefore we've found this, we've found this, we've found this." The whole due diligence process, which will inevitably be gone through, is designed. The cynical view is it's designed for one thing only, and that is to drive the price down and find reasons not to pay you so much. Okay. The other side of it is that typically a trade sale, they are interested in the value of your business from what it will add and how the synergy works with their business. They won't be so interested in the employee legacy. So they want the key people, but they might be doubling up on back office. They might be doubling up on finance, on marketing, on various other aspects. And that, therefore, in very short order can be something they'll say, "Well, we're buying this, but we know we can save here and here." And some of the people that you've worked with for years will no longer be there 6-12 months later. Which leads us back to the walking down the high street where you live and you see somebody where the EOT legacy kind of version leads to reminiscence and smiling, and the other one is they might cross the road and walk on the other side. That's a overemphasis to make the point.
But I suppose on a trade sale, an EOT, you're going to get some money up front and you're going to wait a period of time. With a trade sale, you're going to get the majority of that up front, aren't you? Maybe with an earn-out. Yeah.
These days, I think you can almost certainly expect an earn-out element of a trade sale. The people will say, "Well, we want you, the business owner, the principal of the business, to stick around for 2-3 years to secure the value of what we're getting. And for that, we will reward you. We'll pay you a salary, but we'll reward you with an extra level of proceeds from the sale," which typically will be quite tough, but driven by the performance of the business over that period of time. So depending on who you talk to, you could probably expect, probably 2/3 up front, and then the rest might be deferred. Yeah, those percentages change deal by deal. Yeah.
So management buyout, isn't that the best of both worlds?
Management buyout. You would think this is the best of both worlds. Yeah. So your management buyout, you're selling by definition to your management, your senior leadership team that you alluded to earlier, typically, and that secures, the ongoing legacy of the business, probably both culturally and in terms of employment for your staff. The issue with a management buyout is funding. Okay, so do your senior management team have the ability or the resource personally to pay for that? Yeah, and meet the expectation of a value. Typically, what we find is a management buyout needs external funding, either a bank or a venture capitalist or something external to make the valuation happen to your satisfaction. So, on the face of it, you've got a situation where you're securing some legacy, you're passing to people but to actually achieve the value that you want, there might need to be an outside influence who will be pulling the strings as to how and why and when who will then themselves want some kind of exit plan.
And I suppose that the managers as well have to have a little bit of a skin in the game.
Well,
So they're going to put themselves at risk as well.
Yeah.
So it's quite easy to sit there and be part of a team, but then to actually be responsible for how they're going to pay, which is an extra cost, what they've been currently paying out and how the business has been running.
Yeah. And it's and they therefore are exposed in that way, and that kind of thing. You sometimes you find that you know people, you know the senior leadership team, but as soon as you're then putting that kind of pressure on them, relationships kind of change things.
All right. The next slide, really quickly, is around common mistakes. What's the biggest mistake you see?
People not thinking about this stuff early enough. Yeah. And not being attentive to the robustness of what they can present as this is my company. So be that the financials, the legals, the the contracts, just being able to at a point in time know that. It's something we talk about internally, because obviously we do a lot of this stuff. We do VAT, we do BAYE, we do so in us doing our job, we are aware that actually what we're doing is potentially part of a future due diligence. So it's that. So not having the conversations as wide as possible with the people who may be involved in this, from family to senior management, let alone to potential buyers. It's so important. And gives you power. I mean, information's power in this respect, isn't it?
Absolutely. The next slide, and you've covered a lot of this already, is just that checklist, and you've sort of already taken us through all of these steps, and these slides will be sent out so we can look at those. I just want to make sure we've got some time for questions at the end. But yeah, I think it's just making sure you've got a checklist, that everything is being done, you're speaking to the right people, you've got a communication plan. Most probably we should be topping and tailing that with a communication plan on that list.
Yeah.
Really.
Yeah. And part of this, which we haven't really covered, is just knowing what your business is worth.
Yeah. And the valuation.
Get an indicative valuation.
Brilliant. And the final slide is just going to make it easier for everyone to get hold of us. And I think your team, my team, or all the teams here, we often have conversations with people. And I think from a business owner, sometimes it's quite isolating, because you don't know when to have that conversation with your family. You don't know when to have that conversation with your senior leadership team. You don't even know what your options are. So we put a lot of people in front of you to have those conversations, you and your team. So we are happy to do that. You can get hold of me. I'm very easy to get hold of at samantha.wildman@mpa.co.uk. Go on our website, there's a contact me form there as well. But, if you need someone to just have a soundboard, that's what we're here for, and that's what we can do, and that's what we can help.
Yeah. Cool.
Good. So hopefully my screen will change and any Q&A will come up. While that's happening, I love to ramble on. I think we've got a next session coming up, which is being requested more based more on family business succession plans.
Yeah.
So we can go into that in a lot more detail, and we can look at how it's going to affect inheritance tax, given different options. So we'll definitely get more detail on that.